Hey, the date is December 4th, and it is a Wednesday. Freezing cold outside, hence the beanie and the hoodie. But if you're new here, this video may seem interesting, but if you have seen my other videos, it's going to seem pretty atypical. I don't typically talk about these kind of topics, but uh, today I'm going to be going over just your financial future and how to set yourself up for success. I'm going to be going over setting up a Vanguard account, although you can choose any brokerage account if you're choosing. There's Charles Schwab's, Fidelity, several out there. If you're a beginner, if you just want a refresher, this video is going to be beneficial to you, hopefully. Um, I firstly want to say that with establishing my own financial literacy journey, just within the past couple of years, one thing I've learned is that starting early is the best thing you can do for your financial health. And so I'm going to go over everything from the basics of financial planning to choosing the right funds to invest in. Uh, Quick disclaimer though, before we start, uh, I am not a financial advisor. This video is for educational purposes and educational purposes only, just based on my own personal experience and research that I've done. For advice tailored to your specific situation, you should always consult with a professional or a fiduciary or financial advisor. But with that out of the way, let's just get right onto it. So, why is financial planning a crucial thing to learn? It's going to be going over some key items here. Firstly, you want to build a strong foundation before you start investing. You want to make sure you have a solid financial base. Now, what does that mean? It means living below your means. This is one simple but crucial and often looked over way of doing so. Avoid lifestyle inflation. Just because you're making more money doesn't mean you need to spend more. Just stick to a budget, and as long as you ascend through the socioeconomic ladder year by year, you're just going to be accruing wealth. A lot of people in their 20s, and I'm only 24, but I've already known so many people that fall into this vicious cycle. The second thing you want to do is have an emergency fund. Save 3 to 6 months worth of living expenses in a high yield savings account. This means it's not sitting in a checking account where it can't combat the rate of inflation. This will cover unexpected costs like medical emergencies or a job loss or even a car crash, so you have a K, even 2K in pocket to pay it off. Third thing is you want to pay off higher interest debt. Focus on eliminating high interest debt like credit cards before investing aggressively. The interest you save here often exceeds what you'd earn from investments. The other thing is to allocate 10% of your income to investing. A simple rule to follow is take 10% of your monthly income and invest it. For example, if you earn $4,000 a month, 10% of that is 400. So you set aside $400 for your investments. This creates a habit of prioritizing your financial future and prioritizing yourself without overwhelming your budget. And the key here is consistency if you're starting off, which leads to the next point. Next point, start small, but be consistent. You don't need thousands of dollars to start investing. Even 50 or $100 a month can make a huge difference over time. The key is consistency. So it's habituated behavior. Um, Next thing is to automate your investments so you don't have to think about it each month. Um, what a lot of people fall into is day trading, which is more so gambling and not really investing because you check on it every day. The steps here are to ensure that you're financially secure and you're ready to handle unexpected expenses while letting your investments just grow without having to monitor them constantly. Um, Second key rule is to start early and leverage compound growth. In this case, time is your greatest ally when it comes to investing. Um, so us just take the rule of 70. The rule of 70 helps you estimate how long it will take your money to double based on your annual rate of return. Um, for example, if you earn 7% return, your investments will double in about 10 years. So it's 70 divided by 7 equaling 10. With whatever investment you make, use this simple formula to determine how long it will take for your investment to double in its return. The earlier you start, the more doubling cycles your money can go through, which is again, why it's better to start earlier on. Third rule, the 50-30-20 budgeting rule. Um, if you're unsure how much to invest, uh, if you get anything out of this video, the 50-30-20 rule says that 50% of your income goes to necessities, rents, bills, groceries, things you can't survive without. 30% goes to discretionary spending, whether that be entertainment or travel. 20% goes to savings and investments. Even 20% feels like a stretch if you're starting off. I preferably do more in the 10% range, but if you're more aggressive, 20% could work as well. So you want to start with what you can actually invest in, $50 or $500, and scale up as you proceed and as you ascend through your financial journey. Um, that's pretty much the basics that I wanted to share. Let's move on to the next part of the video. For the next part of this video, I'm going to be going over setting up your retirement account, specifically on Vanguard. There's several brokerages out there. I just use Vanguard because it's what I started with. But it comes down to personal preference. Vanguard is known for its low cost investment options and like pretty great customer service relative to the other ones. Plus, their platform has some of the best, relatively speaking, index funds and ETFs for building wealth. But they pretty much have the same across, whether it's Charles Schwab or Fidelity. They have great UI, which is why I use it. Just a user kind of experience. Vanguard does offer several types of accounts, but today I'm going to be going over specifically the Roth IRA, which is one of the best options for younger investors, especially if you're making contributions from yourself as a freelancer proprietor, not from your employer. Contributions are made with after-tax dollars, meaning your money grows tax-free, and you don't pay taxes on withdrawals in retirement. A Roth IRA is ideal if you're in a lower tax bracket than you expect to be during your retirement age. With a traditional IRA, um, which is kind of the opposite of the Roth in this sense, contributions are tax deductible, but withdrawals in retirement are taxed. If you're unsure which is right for you, again, Vanguard has pretty good customer service and just like a support team that's free if you have an account with them. So consulting with them may or may not be a bad idea. They don't sponsor me at all. It's not an advertisement. It's just personal experience. So as far as the step-by-step guide to opening a Vanguard account, the first thing you want to do is create an account. So you're going to go on vanguard.com and click open an account. Choose start a Roth IRA if you conclude that that's the better option for you. Vanguard may prompt you to transfer funds from your bank, so you have your account info already and like set to go. You're going to link your bank account. The next thing, and this is to fund your investments, connect your bank account. What Vanguard will do is they're going to try to verify this connection with small deposits. You may need to call them up just to make sure it's set up correctly. But you want to set up automatic contributions. This step is key to automating contributions. Say you put $200 or $300 per month. It ensures you're growing consistently with your investments, even if life gets busy. Under the settlement fund, when you deposit money, it goes into a settlement fund like Vanguard's Federal Money Market Fund, the VMFXX, until you decide just where you want to invest it. So it automatically goes to the VMFXX, but you could determine a different source for it later down the line. Obviously, the sections here for me are blurred. That was intentional. But I'm going to explain this as I go through it, just so you have an idea of what the user experience and what the layout and format looks like when you hop on and you make your own account. That's pretty much it for this section. Let's move on to the next one. For the third section, it's going to be all about investing in ETFs and mutual funds once you set up your retirement account or your high settlement fund within your Roth IRA or traditional IRA. Once your account is funded, it's time to invest. So Vanguard offers two main types of investments. Those are the ETFs, which are exchange traded funds. These are traded like stocks. They're flexible and have like low expense ratios. For example, the V00, which I personally invest in on a regular basis tracks the S&P 500. Every brokerage has their own version of the S&P 500, and it's a great beginner-friendly option, I'd say. Mutual funds, these are professionally managed portfolios. Vanguard offers two classes of mutual funds. There's the investor class, which includes lower investment minimums, usually around 1,000 to 3,000. The Admiral class has higher minimums, around 10,000, sometimes lower, but generally they're higher. But lower expense ratios, meaning you keep more of your returns. Pro tip, you should start with an investor class fund if you're just getting started. Once your balance grows to a certain amount, you could upgrade to an Admiral class to save on the fees. But if you don't have money in your account, it doesn't really make sense to start with the Admiral class. A good rule of thumb to know, just to know how much you should invest in an ETF versus a mutual bond or mutual bond fund, is the 100% asset allocation rule. Asset allocation is all about deciding how much of a portfolio should be in stocks versus bonds. The 100 age rule is a popular guideline, something that I learned, and once I did, I kind of just adhered to it. You're going to subtract your age from 100 to determine the percentage you have in stocks versus bonds. For example, if you're 30, 100 minus 30 is 70, so you'd allocate 70% to stocks and 30% to bonds. Stocks provide growth while bonds offer stability. This balance becomes more conservative as you age to protect your wealth from market fluctuation. So as you age, you want to be more aggressive with the amount that you invest in bonds relative to stocks and ETFs. Here's a step-by-step guide in investing on Vanguard. So first, again, you log into your account. You then go to buy and sell section and select buy Vanguard funds or ETFs. You want to choose your investment stocks based on the research that you've done. Again, you can consider V00, which is the S&P 500 ETF, or VTSAX, which is the Total Stock Market Index Fund. Bonds like BND, which is the Total Bond Market ETF, or VBTLX, Total Bond Market Index Fund, in the Admiral shares class are also good options. You should automate your investments, and in the investments section, you want to set up recurring purchases to stay consistent regardless of the market and conditions. A big trap that a lot of people fall into, which is largely associated with day trading, is you make decisions emotionally. Regardless of how the market seems to be doing or does not seem to be doing, you want to, I think personally, just philosophically, you want to make it regimented, where you just spend 20 to 30 minutes a month just doing the automatic tasks that you do in relation to your investments, so it's grounded in discipline and not emotion. So that's pretty much it for this section. Let's move on to the next one. Before we end the video, let's go over some, just let's call them tenets to your financial journey. Things that help me, that I hope can help whoever's watching this. The first thing is you should always diversify your portfolio. You don't want to put all your eggs into one basket, right? A mix of ETFs and mutual funds across stocks and bonds will protect your investments during downturns. And if you have faith and you've done research on a particular stock that's not an index fund, stick with that. It's not always a bad thing if you did your research. And remember that market dips are normal. You should always trust your strategy and avoid emotional decisions. Review your investments on an annual basis and adjust your allocations as you age or if your financial goals just change. Again, if you like this video, just leave a comment, a like. Any feedback is much appreciated. I hope this was helpful, informative. And if you like this kind of content, I know it's kind of atypical from what I typically film. Go ahead and leave some feedback. That's pretty much it for the video. I'll catch you on the next one, and I appreciate you watching. All right.